Hey everyone, and welcome to This Explainer. I'm going to be your professor today, breaking down the exact requirements of IAS 38 for your upcoming accounting exams. If you're an undergraduate accounting student trying to wrap your head around how we account for things we can't even physically touch, you are in exactly the right place. We're going to translate all those standard setters rules into a clear visual roadmap.
Okay, let's take a quick look at our syllabus for today. First, we'll cover what intangible assets actually are. Then, buying versus creating assets, measurement models, aging, so finite versus indefinite lives, and finally, we'll wrap up with a quick IAS 38 pop quiz to test your knowledge. Let's get right into it.
All right, Section 1. What exactly are intangible assets?
So we're starting right at the foundation. What qualifies as an intangible asset under IFRS? The absolutely crucial point here is that it has to be identifiable. That means you can separate it from the company and sell it, or license it, or maybe it comes from a specific contractual or legal right. And, obviously, it completely lacks physical substance. Think of a patent or a software license. You can't literally hold it in your hand like a piece of factory machinery, but it still holds massive, massive value for the company.
Now, to actually recognize this invisible asset on your balance sheet, you've got to prove two strict criteria. And this applies whether you're buying it on day one or adding to it later on. Simply meeting the definition? Yeah, that's not enough. First, you have to show it's probable that the asset will bring future economic benefits into the business. Second, you must be able to put a reliable price tag on its cost. If you can't do both of those things, it doesn't go on the balance sheet.
Moving on to Section 2, buying versus creating assets. Now, what's super interesting here is how the rules completely shift depending on whether you bought the asset from someone else or built it yourself. This is a classic trap where students lose points on exams, so pay attention. If you buy an intangible asset separately, like a completed software package, the standard assumes the probability criterion is already met and you just measure it at its initial cost. Easy, right? But if you generate it internally, like coding your own proprietary software from scratch, well, the standard setters get highly skeptical. They're going to make you jump through some very specific hoops.
So don't fall for this on your exam. Research costs are always expensed immediately. Why? Because during the research phase, you're literally just exploring. You can't prove yet that an asset exists that will definitely generate future cash. Development costs, on the other hand, where you're actually applying that research to a specific plan or design, those have a chance at capitalization. But it's absolutely not guaranteed.
To actually capitalize those development costs, you have to prove all 6 of these specific criteria. You need the technical feasibility of completion, the intention to complete and use or sell it, the actual ability to use or sell it, proof of how it'll generate probable future economic benefits, the availability of adequate resources to finish the job, and the ability to reliably measure what you spent. You have to hit every single one. If you have a brilliant idea and the technical feasibility, but you suddenly run out of adequate funding, boom, you cannot capitalize those costs. They go straight to expenses.
And here is a massive rule you need to memorize for the test. Internally generated brands, mastheads, publishing titles, and customer lists are never recognized as intangible assets. Never. Standard setters argue you just can't separate the cost of building a brand from the cost of developing the business as a whole. So you could have literally the most recognized, valuable brand on the planet that you built from the ground up, but under IAS 38, its value on your internally generated balance sheet is 0.
All right, Section 3, measurement models. Cost versus revaluation. So let's see what happens once this asset is finally sitting on our balance sheet and we need to measure it in future reporting periods. For your exams, just summarize the key differences like this. The cost model is your reliable baseline. You just carry the asset at cost minus accumulated amortization and impairment. The revaluation model, however, carries it at fair value. But there's a catch. If you choose this model, all other assets in that class have to follow suit, so you aren't just cherry-picking the winners. And that's assuming an active market even exists in the first place.
And this brilliantly highlights the strict auditor perspective. To even use the revaluation model, fair value has to be tied to an active market, which specifically requires these 3 exact conditions. Items must be homogeneous, willing buyers and sellers are normally available at any time, and prices are public. Look, auditors are conservative by nature. They don't want management just dreaming up optimistic fair values for unique assets. And because things like patents or custom software are one of a kind, they aren't homogeneous. That means active markets for intangibles are incredibly rare.
Moving along to Section 4, aging. Finite versus indefinite lives.
As time passes,
we have to account for the aging of our intangibles, and this splits into two distinct categories based on useful life. Take a mental screenshot of this table for your exams. Finite assets get amortized, usually straight line if you can't reliably determine the pattern of consumption, but indefinite assets, the ones where there's no foreseeable limit to the cash they'll generate, they bypass amortization entirely. Instead, they require a mandatory annual impairment test to make absolutely sure they aren't overstated.
Now, when calculating amortization for finite lives, how do you determine the residual value? Well, unless you have a guaranteed third-party buyer lined up or a guaranteed active market that will still exist at the exact end of the asset's life, you have to assume the residual value is zero. The baseline assumption here is that an intangible asset will be fully consumed by the company over its finite life, leaving absolutely nothing of reliable value at the end.
Okay, it's time for Section 5, the IAS 38 Pop Quiz.
All right, class, put away your notes. Time for a rapid-fire quiz to test what we just covered. First, think back to our core definition and those strict criteria. True or false, a company can recognize its highly successful, internally generated brand name as an intangible asset on the balance sheet.
The answer is definitely false. IAS 38 explicitly prohibits capitalizing internally generated brands, mastheads, or customer lists. Remember, you just can't reliably separate those specific costs from the daily cost of running the business.
Question 2. Consider the comparison table we just went over regarding aging. Does an entity amortize an intangible asset that has an indefinite useful life? Nope, you never ever amortize an indefinite life asset. Because you can't accurately predict when it'll stop generating value, you can't systematically expense it. Instead, you protect your balance sheet by rigorously testing it for impairment every single year.
Last question. Think about the timeline of an internal project and that trap I warned you about. At what specific stage can a company finally start capitalizing its costs?
You can only begin capitalizing during the development phase, and not a single moment before you clearly prove all 6 capitalization criteria. Any cost incurred in the research phase or in the development phase before you hit those 6 criteria goes straight to the income statement as an expense, and you can never reinstate them as an asset later. To wrap things up, in modern business, the most valuable assets a company owns are often the ones you literally cannot touch. As you prep for your exams, remember that mastering IAS 38 is your key to unlocking how we translate that invisible value onto paper. From the strict 6 criteria for development costs to the auditor's demand for active markets, these rules exist to keep financial statements grounded in reality. So, I'll leave you with this provocative thought. If the world's most valuable companies are built on internally generated brands that never even appear on their balance sheets, what does that actually tell us about the limitations of traditional accounting? Think about that as you study. Thanks for joining me on this explainer, and good luck on your exams.